Street has got more optimistic that the U.S. can dodge a recession, but the Fed and its plans remain wild cards for many investors. We're expecting a clearer picture, maybe, when Chairman Jay Powell talks out in Jackson Hole. That's coming up on Friday. CNBC is going to have complete coverage of the annual gathering tomorrow on Friday. Leaseman is already out there for more. Now let's bring in Joe Lavorgna, chief economist with SMBC Nikko Securities America. I said earlier, you never get a recession when everyone's expecting one, and then you do get one when people aren't expecting one. So once we took it off the table, maybe that allows one to happen. You think that's true? Yes,
we could add it back, Joe, because recessions tend to be nonlinear events, which means there tends to be a shock, some news event, and then we have it. So, for example, in the last deep recession, 08, 09, people, as myself, were thinking recession was going to come sometime in 07. But that was, getting ready for it in 06. We were going through 08. The economy grew almost 2.5% in the second quarter of 08. Had Lehman not failed, that may have been even a more mild recession, if a recession even would have occurred, compared to, say, 2001. So these things can take a while. The problem I have right now, again, is the yield curve is still very inverted.
Not as much, sir.
Not as much, but that's what typically happens when the recession comes, is that the curve then starts to steepen. Okay. But also what's happening now is as those mortgage rates have risen dramatically, way above 7%, you've got high credit card rates, you've got high auto rates, you've got tightening lending standards. All of the inertia, all the momentum is all pointing to the downside. So, yes, recession to me is still going to come. And the lags are such that when you look at the yield curve, you look at the index leading indicators, we are still within the range of what's very plausible for one coming. But again, the date is always difficult to pin down.
The canaries in the coal mine are I guess you're mentioning some. You can find them selectively, but there's also a lot of what's the opposite of a canary in the coal? There's a lot of strong things. We get every time we get an economic number, whether it's retail sales or on the first Friday of a month, or wage gain, any of those things, they're all cooking, are they not?
Yes and no. I mean, if you look at the last handful of recessions, 4 out of the last 6 times, the initial GDP print right before the economy went into recession was over 3%. If you look at previous inflationary periods, you go back to the early 80s, the best job number we had, or one of the best job numbers we had, was July 81, right before the economy turned down. What we're seeing now in the labor market, claims are up. Not a lot, but they are up. Payrolls are slowing. The revisions are downward. 1 or 2 months of soft reading can quickly change that narrative.
So it can happen gradually, then all at once.
All at once. This is why I get back to the nonlinearity.
So what are we looking? Then when are we going to know? What are we going to see? Where would be the back to the canary in the coal mine? What will you see?
The unemployment rate, Joe. The unemployment rate troughed at 3.4. And every time going back 80 years, the unemployment rate has risen 50 basis points from its low. You've either been in recession or recession's coming immediately.
And when will we see that? What month? What does it start? You don't know.
I don't know. I wish I did. I don't know.
We're going to have a strong. What is it? We're going to get one next week. When is that coming? Is it next week?
Already?
What's the
right before Labor Day? Yeah, next Friday.
Is it next Friday?
I believe so. Yes.
So they'll do it. Sometimes they don't. So we'll get a judgment. You expect that to be big? We'll know. We'll get the ADP next week. We got something to look forward to, right?
Yeah, something to look forward to. But look, the thing that I come back to is monetary policy. What's happening with real interest rates, the yield curve, lending. All of these things are going to work to break economic activity.
No, it's a week after next. They wouldn't do it on September 1st, would they? I don't think they do it if it's September 1st.
No, they can't be September 1st.
They could release it on September 1st?
Yeah, they've done it before.
I think maybe we should know. We'll find out whether it's September 1st or whether it's September 8th.
But anyway, the point is that just because it hasn't happened doesn't mean it won't happen. And the conditions that argue are right for it still to occur. No question. The index leading indicators, for example, that's down about 9% year on year.
It is September 1st.
That's what I thought.
Yeah. Report? Yeah.
That's nutty. What's Jay Powell going to? Does it matter? This is in motion, or
yeah, no. Jay Powell buys flexibility. In other words, the funds rate's 5.5%. The market still thinks they may hike again, possibly. We've taken out a lot of the easing. They're much higher now than where they were last year at this time. He could sit back, relax, adopt a flexible or data-dependent approach.
Are they already too far, in your view?
No. Oh, I've been saying that for a while.
You have, but it hasn't been right yet.
Well, hold on a second. the Fed added $400 billion in liquidity with SVB. And to their credit, in 48 hours, they rolled out all these lending programs, backstop all the depositors, and that was a page from the COVID and obviously financial crisis playbook. So to their credit, they did a lot to sort of paper over some of these problems. But as your other guest, Peebles, was saying earlier, I mean, there are a lot of problems with the commercial real estate market. There are a lot of, I would argue, issues below the surface. And these rates, when you could earn 5% plus in the Treasury market, I mean, look at the equity risk premium. The equity risk premium is significantly negative. And it doesn't mean stocks can't continue to go up. But eventually, that capital and that liquidity is going to move, I think, in the short end. And that's ultimately going to be detrimental.
Does inflation stay too high and we get a recession?
No, because inflation.
So inflation will come down?
But this is the thing. I've been actually in the transitory camp. If you look at the CPI, core CPI, you take out shelter, we're up 2.6 over the past year. We're up about 1% over the past 3 months. We know shelter is going to come down because we've got good rent data that says it's sticky based on how the BLS measures it, and those rents are going to be weaker. So this notion that somehow inflation is going to stay here, I think, are wrong. And if we have a recession, we have never had one where inflation didn't fall when you've had a recession.
All right, Joe. Damn, you're sure.
Why is rent going to definitely get weaker if there's...
Because you look at like...
wants to get a mortgage.
In aggregate, if you look at the amount of supply that's coming on for rentals, like Zillow and these other rental indices, they've all slowed down. Also, a lot of these Airbnbs will probably be rentals.
Oh, interesting.